Welcome to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Greifeld. And Scarlett Fu, we are on record watch.
For stocks, for Bitcoin?
Luckily, we have both covered in ETFs. So let's talk about the $12 trillion global ETF industry right now. Vanguard CEO Tim Buckley announcing he's retiring at the end of the year. We're going to discuss his legacy and the search for his replacement.
But first, we're going to speak to Douglas Yones of the New York Stock Exchange. We're going to get his take on trading and the impact of spot Bitcoin ETFs.
And of course, as Reddit eyes its potential IPO, we're going to speak to Avery Marquez of Renaissance Capital on a fund that provides exposure to newly listed companies. But before we get there, as always, Eric Balchunas from Bloomberg Intelligence is with us now, and he's looking at the flows. Eric, what do you got?
Katie, Scarlett, thank you very much. Look, the flows bring more good news. 2 weeks in a row of very bullish sentiment in the flows. The Qs at the top is probably the most bullish you can get, right? That's full of Magnificent Seven stocks. When will it end? I don't know, but it keeps going on and on, right? IVV number 2, VU number 3. So there's the S&P there for good measure. Bitcoin is 4th. IBIT punching way above its weight for a new launch with 2.1 billion. A couple bond ETFs on there, nothing to write home about. Largely equities, throwing some SPY down there, another Bitcoin. Bitcoin and stocks, I think, are the two big stories this year. Let's look at the outflows to get a more complete picture here of the market. And you can see some bond ETFs at the top, BNDX. GBTC is part of that Bitcoin story. There's a huge unlock there that continues to bleed. That's the probably the Genesis money coming out. HYG, EMB, that's more bonds. And IWM. People keep trying to make small caps happen. They don't, and then they get out. And so I've seen this over and over, that IWM was topping the list about 3 weeks ago. Now they're done. So I don't know what can possibly change this regime. But speaking of bullishness, let's look at this really cool new feature we have on BI that Athanasios Serafagos on my team created. It's the fear and greed indicator. We looked at things like leverage long usage, puts and calls, short interest, ETF flows, and we put it all together to say how bullish are ETF investors. So this blue line is our indicator, and you can see it's pretty high, about 0.6. And this is the S&P. It's definitely correlated with the market, but it's not quite as high as it was in 2021. Remember, that was like the mega bullishness. We'll call this euphoric, right? So we're not quite there. We're a little below it, but we're getting there. So our phrase, Katie, is comfortably bullish. That's what investors are. It's going to take a lot to get them uncomfortable and to get out of this trade.
All right, comfortably bullish. Maybe Pink Floyd will write a song about that one too. Eric, thank you. And joining our conversation now is Douglas Yones. He is head of exchange-traded products over at the New York Stock Exchange. He came uptown for us. And Douglas, let's talk about fear and greed in the ETF industry, because something that's striking to me is that you take a look at 2023, you had basically close to record launches when it came to ETFs, but you also had close to record closures. But talk to us a little bit about launches so far. What have you seen so far in 2024?
Yeah, this year's been somewhat of a repeat of last year. We're seeing active management really shine, if you will. The majority of launches in new ETFs has been active management really for the last 3 years. That number grows year upon year upon year, and it's because they see early success. Active managers see pretty early success in terms of cash flow, in terms of acceptance into the industry, and really that starts to drive new business. Ultimately, we are, as you mentioned, we're seeing record launches and also record closures, but what we're not really seeing is the closure rate in such a short capacity. What I mean by that is, it used to be people would just sort of launch anything and hope it sticks. That's gone out the window, and I think you've seen that from other participants in this show over the last few weeks. People have to come to the market with a game plan. A lot of them bring their own assets. They have a marketing and distribution plan. So if there's closures, it's a result of maybe those ideas are no longer taking shape in the markets.
So active ETFs are seeing an increase in flows, but passive obviously attracts the lion's shares of flows overall. Do you think passive will always have an advantage over active, or do you see the two approaches at some point reaching parity?
Yeah, I don't know that it's an advantage versus disadvantage. It's just the way a lot of people invest. We tend to think about portfolios in the advisor world about core, satellite, multiple versions of that core. And so, passive cheap beta is an easy way to get exposure to a lot of different places. But at the end of the day, it's pretty rare you find an advisor or a sophisticated shop just choosing active or passive. I think that debate's gone. What we're finally seeing is some of the world's best active managers are finally coming into the ETF space. They're seeing their day. There's a lot of adoption rate, and so they're excited. And there's an easier path to get there after the SEC Rule 611, excuse me. It really paved the way for active management to enter the industry.
So let's talk about trading. You know, you guys like to see volume. That's what the first ETF was launched, to get volume on Amex, right? So ETF volumes, if you look at the past couple of years, they're elevated. It's like a new normal was hit about 3 years ago, and it's maintained, you know, 30 to 40 trillion dollars in trading every year. Why is that? What was that jump up? Is it more people trading, or just that $1 billion isn't what it used to be? Or here's a chart you can see here. See how it's kind of set at that new higher level? What's that from?
Yeah, it's a number of different factors, and you're spot on. The number grows every single year when it comes to total trading at the New York Stock Exchange. So the percent of volume that comes from ETFs grows year upon year. It's coming from a number of factors. One is ETFs offer a very easy and convenient and inexpensive way to target certain aspects of the market. It might be a certain sector, might be something you're talking about here. Investors want to get in quickly and maybe exit quickly, so ETFs allow for that. The second is on the longer term investor. ETFs, as we know, they tend to be lower price. They tend to have a lot more transparency. We know exactly what we're investing in. They are becoming the wrapper of choice for more and more investors across every demographic, whether it be all the way down at retail to all the way up at institutions, insurance companies, pension plans, et cetera. They want to tap into a much more tax efficient wrapper, a lower cost wrapper, an ease of use wrapper. And so you're seeing adoption rates also as a preferred method of investing. Instead of choosing a mutual fund, I'll choose an ETF. So it's coming from a number of different places. And then maybe the third place is some of these more historically out of reach or esoteric asset classes, things like trading covered calls or option strategies, things like access to Bitcoin. You talk a lot about Bitcoin on the show, I know, as a viewer. These were historically hard to reach for a lot of different demographics. ETFs offer access.
Yeah.
And so the more access vehicles that come on market, the more trading we're obviously going to see.
Well, I'm glad you brought up Bitcoin, because we're about 7 minutes into the show. We haven't really talked about it yet. I was getting
How did we get this far?
I was getting a little bit itchy here. So, I mean, we're talking about overall volume, but talk to me about the trading volume that we're seeing in the spot Bitcoin ETFs, because I think most people have been surprised by just the amount of money coming into these things. What are you seeing on the trading volume side?
Yeah, the trading has been, you know, by all terms historic. And I think I've seen a number of different research reports coming out of Eric and his team around, of all ETFs that have ever launched, how many have had this much trading right out of the gate. It's so few and far between that an ETF comes in, but they are access vehicles. They provide access to a place where a lot of different investors maybe were uncomfortable to open up their own wallet, or they were an institution, they had no ability to do a wallet. The Bitcoin ETFs are taking care of that. In my world, in my lens, we think not about product development, just about product development and bringing them to market. We want a very clean, efficient, comfortable market that has a lot of liquidity. And that's what we've seen. So yes, you've got these record-breaking historic launches, but no one's talking about inefficiency of the market or difficulty trading, and I'm trying to do a large size order and I can't do it. We've solved for all those things. That's usually our world. We tend to think about the New York Stock Exchange. The liquidity profile around these ETFs has been also historic. And I think because we're not talking about that is actually a big win for the industry.
And look, let me follow with another Bitcoin question, since you brought it up.
Yes, of course.
Yeah. So if you look at the volume, right, you look at, say, I'll use one that trades on NYSE, BitB. Let's say it trades $150 million that day. What people online are looking for is how much of that converts into flows. So you'd think for a new fund, most of the volume would be people buying it, right, because there's not many sellers left. But isn't there this like sort of ARB and algo world that actually adds to that volume that isn't just people buying it? Can you explain that dynamic a little bit?
I can, and I'm going to be super nerdy about it when I do, if that's okay with you, Eric. But if I take everyone back in time to when we had to learn economics and we thought about money supply, and there was M1 and M2 and how it all worked, to some extent ETFs work the same way. We all have dollars in our pocket, maybe some people less than others, that we'd hold on to because cash is no longer what it used to be. But there's a certain amount of cash that you need to be super liquid right now. If I go out on New York City and I buy a hot dog from a vendor, I need cash in my hand, not just a credit card. To some extent, ETFs act the same way. Market makers, liquidity providers, hedge funds, people making quick short-term movement, they can't just rely on the create-redeem mechanism. That takes time. They have to call up Bitwise. They have to put a creation order. They got to wait for settlement. So a lot of these trading parties, all these different people need liquidity. They want to have that on their books. So what we end up seeing is a lot of creations come in, and then that liquidity sits on their books. And then, yeah, they're going to trade, and they're going to sell, and they're going to add liquidity. But it's just trading between itself. It's cash moving between hands. And that won't result in a creation or a redemption order. So it's never going to be one-to-one. And as we see, as ETFs get larger and larger, the percent of trading that can go up before it actually yields in a create-redeem, it can be quite high. So, of course, the early brand new ETFs, the more they trade, the more we see creations. But over time, that starts to settle out.
All right, very quickly here, we have more than 10 plus Bitcoin ETFs out there, with Bitcoin continuing to surge to records or making a run for the record. At what point do you start to see a consolidation in the number of those Bitcoin ETFs?
I don't think we've seen in the ETF world anyone say, well, I'm successful here, let me consolidate. So it would probably take lack of success for someone to think about consolidation. Rather, I would expect the next iteration. So people who might want to use Bitcoin in different ways or a percentage of funds. Multi-asset ETFs are doing well in the last few years, but as I said, active management seems to be the new growth area. I think one interesting stat that we looked at last year, over 70% of all actively managed ETFs had positive net cash flow last year. That really says something about the market's interest and adoption of active ETFs.
All right, sadly, we got to leave it there. Hope to have you back soon. Really enjoyed this conversation. Of course, that is Douglas Yones of the New York Stock Exchange. Now coming up, a shakeup at Vanguard. After almost 6 years at the top, CEO Tim Buckley is set to retire at the end of the year. We're going to discuss the search for a successor next. This is ETF IQ on Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. Time now for the ETF Brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with Goldman's hedge fund ETF. A lot of buzzwords there. You can see the ticker is GVIP here in orange. Over the past year, it's up almost 38%. That is well outperforming the S&P 500, as you can see in white there. Of course, this is a very tech-heavy portfolio, so probably no surprise, but a win for the hedge funds. Let's also talk about cows. Specifically, we're talking about cash cows. Ticker here is COWZ. This is an ETF from Pacer that tracks companies with high free cash flow yields. That has delivered a little bit of outperformance, and it's delivered a lot of inflows. This fund actually hasn't seen an outflow since October or so, now at $20 billion in assets. And we also need to talk about Vanguard, because we're seeing some shakeup at the top. The big news from last week is that Vanguard CEO Tim Buckley is going to retire at the end of 2024. He's spent more than 3 decades at Vanguard. He's been CEO since 2018, and now the firm is looking for a successor, Scarlett.
All right, so let's talk more on Vanguard's changing of the guard with our very own Eric Balchunas. Eric literally wrote the book on the firm. It's called The Bogle Effect. It's on how founder Jack Bogle and Vanguard disrupted Wall Street. Eric, so this was a little bit of a surprise. It certainly got people in the ETF world talking. What is Tim Buckley's legacy? How did he put his stamp on the firm that Jack Bogle founded?
Yeah, sure. I mean, the reason it was a little bit of a surprise is Vanguard's just doing so well. All systems go. If you look at ETF flows, they've taken in over half of the net flows this year. They do very Vanguardian things that you're so used to it. But what they do is commonly like just, wild. For example, under Tim Buckley, ETFs have taken in, or Vanguard has taken in almost $1 billion a day, $3.6 trillion in asset growth. That's more, like their asset growth under him is more than like 2 or 3 entire asset managers have in assets. So this is like a whole nother level. In addition, he created the personal advisory service, or he built it. This is Vanguard becoming a wealth manager. This is crucial because some of their clients are getting older. They need more help with their finances. That has $350 billion in change, something like that. And then also, I think leaning into the ETFs was big. Bogle did not like ETFs. So every successor since Bogle has moved more into ETFs, and he continued that. And that's smart because ETFs are clearly the vehicle of choice over the mutual fund going forward. And Vanguard leaning in, they really benefit from each other. ETFs got pressure on low fees, which helped their flows, and Vanguard got liquidity, which helps keep the long-term investors protected from trading costs.
And this is a little bit of a wild card question, but of course you tweeted out this news and everyone in crypto Twitter found some sort of link between the fact that Vanguard decided not to allow Bitcoin ETFs on their platform and now Tim Buckley stepping down. I don't know if you would make that connection.
Yeah, no, there is no connection. The amount of touchdown celebration going on by the crypto people, they were like, oh, we got a scalp.
Oh my God.
Another scalp. And I'm like, oh my God, these guys, some of these guys are crazy. Anyway, had nothing to do with this. Yes, Tim Buckley was probably behind the decision not to let Bitcoin ETFs trade on the platform. But you have to know, most Vanguard investors want nothing to do with a Bitcoin ETF anyway. This is not a big deal. For the crypto crowd, they were insulted by it, and they think it's correlated or related, but I would say it's not.
Okay, as Katie mentioned, Vanguard is conducting a search for replacement. What kind of place is Vanguard for the ETF talent out there? Is it a destination?
Yeah. Well, it depends if you like living in Malvern. I like the suburban life. I could see living, but
a lot of trees.
Yeah, it's a different kind of vibe. It's almost, some people have called it a cult. It's definitely its own thing. You might not make as much money if you're at that level, but there's probably some karmic or psychic income from knowing you're giving low cost to investors. That's generally the pitch for there. And so I think, Greg Davis, is they're promoting him to president. He would be my first idea of who might do it, or Salim Ramji, who just left BlackRock. There's a couple other outside the box, but that person's going to have to focus on customer service. That's their one Achilles heel. That should be what the next CEO focuses on.
All right, and get paid in karmic insight as well.
I love that.
Eric Balchunas, of course, author of The Bogle Effect and senior ETF analyst here at Bloomberg Intelligence. Still ahead, we learned recently Reddit is eyeing a valuation of up to $6.5 billion in its IPO. So next, we drill down into the world of IPOs with Avery Marquez of Renaissance Capital. This is ETF IQ. This is Bloomberg ETF IQ. I'm Scarlett Fu along with Katie Greifeld.
And it's time for today's drill down where we focus on one ETF. Eric, take it away.
Okay, Katie, we have IPO today. This ticker speaks for itself. This is the IPO ETF from Renaissance. It's been around for about 10 years. This ETF, it's pretty basic, right? IPOs come out all the time. This ETF will hold it very shortly after the IPO comes out, and then it will keep it for 3 years. I used to call these catch and release. The reason these are novel, in my opinion, is that a lot of stocks, it takes a while to get into main indexes. Indexes are very, there are a lot of hurdles you have to jump over for a stock to get into a big index like the S&P. So these hold these stocks before they get into the broader index world. And you can see it's 60 basis points, 10 years old, as I said, $180 million, so pretty big. Let's look at some of the IPOs in this thing. Some of these names that you're going to recognize from just the media and whatnot. Coinbase is in here, got a little Roblox, which my kid likes. A couple, Rivian, you got a bunch of other IPOs in here. And so these are going to be in here for 3 years. You can see the weighting's going to differ. Coinbase getting the top weighting there. So the weightings will matter, so you want these to do better. The key for an IPO ETF is you want a couple superstars to carry some of the ones that don't work out, like a Meta or a Tesla. Let's look at the performance of this ETF versus SPY and versus FPX, which is a First Trust product that also does IPOs. And you can see it is trailing the First Trust and the S&P, got to be honest here, but this one's going to have bigger rips. So when it does rip, it usually will outperform those two in given periods. So listen, Katie, novel idea here, something that isn't really in bigger indexes, and that's why it's got $180 million.
Eric, thank you. And joining us now to talk about this ETF, I'm thrilled to say we have Avery Marquez. She is our assistant portfolio manager over at Renaissance Capital. And Avery, I want to talk about how long you hold the stocks because, of course, Eric mentioned Coinbase. I was checking. Coinbase went public in 2021. A lot of people would say that's old news. So what is the wisdom behind how long you actually keep an IPO stock in the IPO ETF?
Yeah, absolutely. Our holding period is 3 years post-IPO. We believe that this time frame allows for us to hold unseasoned equities, like Eric mentioned, names that aren't making it into major indices, while also keeping it towards more of a current snapshot of the IPO market.
So we have Reddit eyeing a valuation of up to $6.5 billion when it does finally list. Based on that and the upcoming pipeline of IPOs coming to market, how do you expect the industry exposure of IPO to change this year?
Yeah, I did see that news about Reddit. So that is something that we're excited about here at Renaissance. I think that going forward, we do expect to see a tech revival in the coming months. So the composition of IPO will still likely be favored towards tech. However, we do expect to see some large consumer names, some financial names. So kind of keeping with that mix that we currently have. And that really makes sense to what we see in the IPO market in a typical market. Where these are the types of sectors that are producing the largest IPOs. So ultimately, for a fund that is looking at the top 80% of a group by market cap, those are the sectors that are going to be most heavily represented.
And could you talk a little bit about when you buy it? Because, you know, people think when an IPO comes out, sometimes it's bid up and people sell it the first day. There's a lot of volatility. How do you manage that so you don't lose any money on those first couple days?
Yeah, absolutely. We do not participate in IPO allocations. That does not align with our methodology. So we're really operating in the aftermarket, but that is where most of the trading happens anyways. Our methodology allows for stocks to be added, the rebalance after they go public, given some buffers in that time frame. So the initial trading is important, but that aftermarket performance is just as important as well.
And Avery, I mean, looking at the portfolio right now, you have 59 holdings. And like you said, I mean, you hold these names for 3 years, but I don't need to tell you that the IPO market, it's been pretty dry over the past couple years. It's expected to pick up a little bit this year. Of course, you have the Fed cutting rates, et cetera. But what is the game planning around if there isn't an IPO pickup and some of these names start to drop out? I mean, how much could the portfolio shrink and what are your plans around that?
Our methodology does account for if we were ever to encounter a serious IPO drought. We do have safeguards in place that provide a minimum number of holdings so the fund doesn't get too small, too concentrated, possibly pausing deletions if it were to drop below that number. That hasn't happened to date. Even with the last 2 years of a slowdown, we've still had some large IPOs come to market, and those are the names that are making their way in. You see Kenvue and ARM, but the universe has stayed robust thanks to that boom in 2020 and 2021. So yeah, if there were to not be a pickup like we are expecting, we do have safeguards in place to prevent any serious concentration in the fund.
All right, Avery, got to leave it there. Really appreciate your time. That is Avery Marquez of Renaissance Capital. And if you just can't get enough ETFs, reminder, you can listen to Trillions by Eric Balchunas and Joel Weber. But that does it for us on Bloomberg ETF IQ. I'm Katie Greifel along with Scarlett and Eric.